Hello, I'm David Chaston, standing in for Bernard Hickey with an economic weather report brought to you in association with the BNZ. New Zealand's current account balance showed a deficit of $3.6 billion for the December quarter in data out just a few minutes ago. This comes after the first surplus in 20 years was recorded in the September quarter. This data surprised on the negative side, coming in at minus 2.9% for the year compared with GDP. And that contrasts with economists' forecasts of about minus 2% and the RBNZ's own forecast of minus 2.2%. All of them will be surprised. A current account deficit means that New Zealand's overseas expenditure is greater than its earnings abroad. The change from a surplus to a deficit was driven by an increase in income earned by foreign investors from their New Zealand investments. Company profits are returning to levels seen before the effects of the tax changes and the financial crisis, according to Statistics New Zealand, who released this data. Foreign-owned companies reinvested a record $1.5 billion of their profits back into the New Zealand economy during the December quarter. And what does all this mean? Well, if these weaker balance of payments numbers are also reflected in tomorrow's GDP numbers, then the recovery is not as strong as many, including the Reserve Bank, were expecting. That could mean that Alan Ballard keeps the OCR at its unusually low accommodative rate of 2.5% for longer than he signalled less than 2 weeks ago. Then he was still saying that he would start to unwind the low rate regime from about the middle of the year. All eyes will be on tomorrow's GDP data, and if that is also weak, the low OCR may be extended further into 2010. Certainly the wholesale money markets are not pricing in any impending rise. That was an economic weather report brought to you in association with the BNZ.